Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of the weird and wild world of corporate finance. And in this filing, we're going to look at Electro sensors. And boy, do they have some interesting numbers to report. Before we dive in, make sure you're subscribed because we're constantly digging into these filings to bring you the real story. And join our Discord community linked in the description below. Electro Sensors is a company that makes industrial machine monitoring and control systems. They sell to a wide range of industries across the globe. Let's get straight to the good stuff, the financial tables. And I want to focus on a few key numbers to understand how they're doing. First up, the balance sheet as of June 30, 2025. Compared to December 31, 2024, we see their cash and cash equivalents are sitting at around $10.2 million, which is a slight increase from about $9.9 million at the end of last year. Their investments are static at $56,000. This is a small amount, but it's worth noting it hasn't changed. Now, their trade receivables are down slightly to about $1.3 million, but look, the allowance for credit losses has jumped significantly from $11,000 to $28,000. This could mean they're being more cautious about collecting money from customers, or they're expecting more bad debts, which isn't a great sign. Inventories are up a bit to $2 million. This could be good if sales are also picking up, but if sales slow down, this could become a problem. Overall, current assets are up slightly too, sitting at just under $13.8 million. On the other side of the coin, their accounts payable has more than doubled from about $146,000 to $287,000. This increase might be due to higher purchases, or perhaps they're taking longer to pay their suppliers. Their total current liabilities have climbed to over $76,900. Now, for the stockholders' equity, it looks pretty stable, with common stock at about $344,000. Additional paid-in capital has increased a bit to $2.4 million. Retained earnings are holding steady at about $11.6 million. Overall, their total stockholders' equity is around $14.4 million. Let's move to the income statement, or as they call it, the statement of operations. Over the 3 months ending June 30, 2025, net sales were $2.4 million in the same period last year, an 8.3% jump. And for the first 6 months of the year, sales reached $4.6 million, which is up about 4% from last year. This growth seems to be driven by increased sales to international and OEM customers. So that's a positive trend. Gross profit for the second quarter also saw a nice jump to $1.2 million, up from $1 million last year. This means their gross margin improved significantly from 47.2% to 51.2%. This improvement is attributed to higher selling prices to counter rising material costs. That's a smart move. For the 6-month period, gross profit is up to $3 million, and the gross margin improved from 47.7% to nearly 50%. Now let's look at operating expenses. Went up in both periods, mainly due to hiring more people. Specifically, selling and marketing expenses rose by about 22% for the 6 months. This is linked to new sales leadership. General and administrative costs also edged up about 5.3% for the 6 months. This was due to things like auditor fees and other expenses, but it was partly offset by savings from fewer contract workers. Interestingly, research and development expenses went down by about 12.5% for the 6-month period. This is chalked up to reduced employee headcount in that department. Despite the revenue and gross profit increases, the company reported a very small operating loss in the second quarter of just $2,000. That's down from a loss of $1,700 last year. So a significant improvement there. However, for the 6-month period, they posted an operating loss of $1,001,000, which is actually $7,000 loss in the same period last year. On the non-operating side, interest income decreased for both periods, mainly because of lower interest rates on their investments. Income tax expense is a bit unusual. For the second quarter of 2025, it was $2,100 compared to $6,000 last year. The effective tax rate jumped from 300% to 26.3%, which seems like a correction from an extremely high rate last year. And the net result for the 6 months ending June 30, 2025 was a net loss of $5,000. This is compared to a net income of $7,000 in the same period last year. So a slight dip into the red there. The earnings per share figures are tiny, reflecting these small profits and losses. Now let's look at the cash flow statement. For the 6 months of 2025, operating activities generated $24,000 in the same period of 2024. This improvement seems to come from increased accounts payable and decreased accounts receivable. Investing activities used $13,000 for purchasing property and equipment, a rather small amount. Financing activities, on the other hand, showed no cash flow in either period. Looking at their investments again, we see they own equity securities valued at $56,000 at June 30, 2025. This hasn't changed since December 31, 2024. Interestingly, these investments are categorized as level 3 in the fair value hierarchy, meaning their value is based on unobservable inputs. This suggests these are likely private company investments where the value is harder to determine. Shifting to stock-based compensation, the company recognized $22,000 in expense for restricted stock units or RSUs in the second quarter and $43,000 for the 6-month period. The total unrecognized compensation expense for RSUs is a considerable $27.13 if Deathany $100 pair some dollars had. For stock options, they recognized $1,000 in expense for the second quarter and $20,000 for the 6 months. The unrecognized compensation expense for options is about $95,000. A notable event was the retirement of board member Michael Zipoy, effective August 8, 2025. In recognition of his service, his outstanding options and RSU awards were accelerated. We also have a subsequent event, a new law called the One Big Beautiful Bill Act, signed in July 2025. This act makes permanent certain tax benefits like bonus depreciation and immediate deductions for research expenses. The company is still evaluating the full impact of this law, and we'll see those results reflected in their next quarterly report. Digging into the management's discussion and analysis, we see they are cautious about forward-looking statements. They mention that actual results could differ materially from their projections due to various risks and uncertainties. They also state that there have been no changes to their critical accounting estimates during the period, which is generally a good sign. They also reiterate that the preparation of their financial statements relies on estimates and assumptions, but there haven't been any major shifts in these estimates. Looking at the selected financial information presented as a percentage of net sales, we see a clearer picture. The gross profit margin improved, which is good, but operating expenses as a percentage of net sales also increased slightly for the 6-month period. The increased selling and marketing expenses are detailed here, showing a 24.9% rise in the second quarter, primarily due to hiring sales leadership. The decrease in research and development is noteworthy. It's down about 19% for the quarter and 12.5% for the 6 months due to fewer employees in that area. This could be a signal of a change in their product development strategy. The drop in non-operating income is mainly due to lower interest income, which makes sense given the current interest rate environment. The effective tax rate for the 6-month period ended June 30, 2025 was a whopping 400%. This is explained by adjustments to their calendar year 2024 tax balance and write-offs of deferred tax assets from expired stock options. It's a complex tax situation. And regarding liquidity, cash and cash equivalents increased to $10.2 million, driven by positive cash flow from operations. The significant jump in operating cash flow to $24,700 is a strong positive indicator, and it seems to be helping their overall cash position. The company acknowledges ongoing challenges in supply chain and labor. They are actively seeking new sources for components and redesigning products to use more available parts. They also note the labor market is challenging and costly, which could impact their operations. And finally, they continue to explore growth opportunities, both internal and external, including potential strategic acquisitions and business development initiatives. Now, for my take on Electro sensors, based on these numbers, the company is showing some signs of life with increased sales and improved gross margins. However, the slight operating loss for the 6-month period and the significant increase in the allowance for credit losses are areas to watch. The reduction in R&D spending could also be a concern for future innovation. Their cash position seems healthy, and the improvement in operating cash flow is a definite positive. The tax situation is a bit of a mess, but that seems to be more of an accounting artifact linked to stock options and timing adjustments. The stock-based compensation is standard for a company of this type, and the information about the board member's retirement is standard practice. The impact of the new tax law is still being evaluated, which is also normal. Overall, Electro Sensors seems to be navigating a challenging business environment with some smart strategic pricing, but they're not out of the woods yet. The key will be their ability to convert that improved gross margin into consistent profitability and manage those R&D investments wisely. All right, that's our breakdown of Electro Sensor's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.